On that note, let's welcome in our market master for this evening. We have Mayuresh Joshi of Angel Broking joining in. Mayuresh, hi. So, global markets are completely focused on what's going to come out of Jackson Hole. But nevertheless, as we wait for that global event, what do you make of the weakness that we've seen today?
Evening, Surbhi. I think today's weakness was more to do with expiry and the expiry related events, which probably saw some profit booking on the bourses. But largely, I think if you look at the holistic picture, the earnings have been quite reasonable. I think it had been a mixed bag, but they are showing signs of revival. So the entire take is the second half should see some amount of respite coming through from the corporate earnings front, based both on the factors that monsoons are good, the discretionary spending will increase, the 7th pay commission will also add boost to the consumption spend. Having said that, probably I think what happens with the Fed meet is an important global event, and again any movement on the Fed rates over the next few months will have some amount of tremors probably in the global markets, specifically the equity markets, and that probably will have some amount of consolidation or profit booking across bourses, because a whole host of markets have moved up significantly and valuations again are not too cheap at this point of time. So again I think consolidation is the theme probably for the equity markets. Any correction that we probably see, if it comes through over the next few weeks, can be seen as a buying opportunity, selective stocks that investors were wanting to buy, and that correction will also make the multiples a little bit more cheaper than what they are deriving at the current moment.
Apart from valuations, Mayuresh, is there any other reason or any other cause of concern you think which is leading to this decline?
No, again, Surbhi, I think largely the move that we've seen right now across global markets, including India, is more to do with the kind of liquidity push through that we've been seeing. As I mentioned earlier, I think for the markets to re-rate from these levels, because again valuations around 17.5 times forward earnings are quite there around 3 and 5 year averages. So long-term averages, probably the valuations are quite fair to say the least. But again, I think corporate earnings should revive, which I've mentioned should start seeing some revival in Q3. CapEx cycle again would largely depend upon how the environment probably moves up and how the macro data points move. So looking at the data points that we've probably seen so far in terms of IIP, if we see some consistent trend happening on that front and inflation cooling off because of good monsoons, you will see the private capex pick up in the second half as well, which would lead to corporate earnings revival, and that would be the key point. But again, I think till that point of time, I think you'll have to wait one more quarter, and again I think global cues will probably determine the fate of the markets in that time interim. So largely I think India is well placed, well poised within the emerging pack, strong forex reserves, the reform processes are on. Because of the reform processes, we might have actually a sovereign rate upgrade, which can be a huge positive for our credits rating. So largely I think a lot of positives for the Indian markets, but from a short-term perspective, we might just consolidate in this range.
All right, on that note, let's quickly move on to a big important development that's come in for the bond markets. And perhaps you can say that it's the final hurrah from Governor Rajan as he gets ready to say goodbye to Mint Street. The RBI has announced a raft of reforms to spruce up the corporate bond market. Most of these reforms were recommended by a working committee headed by former Deputy Governor H.R. Khan. Lata is here to explain to us what these measures are and how significant they could be. Lata?
Well, a bunch of reforms have been announced. It's almost like writing a new constitution for the corporate bond market. The most important among them would be removing the 7-day restriction for lending by listed companies to banks. Now, if a listed company has a lot of money, say for instance Reliance Industries, it has to keep a minimum 7-day deposit with a bank. If it keeps it in the current account because it needs the money in 2 or 3 days, it doesn't earn any interest, it's zero. Now, companies like these which are flush with cash can do a repo in the corporate bond market and make money on 2-day lending, 3-day lending, 4-day lending. So really the current account of banks can shrink because of this. Good for corporates, not very good for banks. They have to be smarter managers. But there are a number of other measures announced as well in the fixed income market. For one thing, foreign investors, FIIs or FPIs as you call them, can directly go to the exchange in which bonds are traded, called the NDSO, and trade on their own. They don't have to go through a bank. So banks lose some fees. Likewise, these FIIs can also go to the exchanges, stock exchanges, and trade on corporate bonds, buy or sell them. So there again, a little bit of margin is lost. What is good for the bond markets also is that banks can give what you call credit enhancement for corporate bonds. Many corporate bonds are illiquid, especially if you're a AA, A or a triple B. Banks can say that the first 20% of loss I will bear if the issuer doesn't pay back. Now the 20% limit has been raised to 50%. It's called partial credit enhancement. That also is positive for the bond market. Then there are a lot of measures positive even for banks. For instance, banks can now access the foreign rupee market, what you call masala bonds, to raise tier 1 and tier 2 debt. There are other important relaxations granted by the Reserve Bank for those who have to hedge their foreign exchange. This is for corporates. If they have to hedge their foreign exchange up to 30 million, the procedures have been simplified. They are also looking at simplifying ways in which Indian corporates want to hedge their commodity risk in overseas market. There nothing has been announced, but they are looking at it. There is also a move whereby people with large exposures, that is banks having large exposures to some indebted groups, like say the Adani group, the ADAG group, the SR group, where you have large exposures to one group. There the exposures will have to be brought down, but simultaneously these groups will also be encouraged. In fact, any large corporate will be encouraged to borrow partly from the bond market. They are also going to permit brokers in the corporate repo market, as well market making in government securities. At the moment, market making is allowed, but it only happens in very liquid securities. Even in semi-liquid securities, market making is going to be allowed, in which case these market makers, PDs or brokers, can take loans, a line of credit from banks. The most important measure which was not announced today but which was promised is that when the Reserve Bank gives money in the repo window, daily repos, it only accepts government securities as collateral. It will start accepting corporate bonds. Now there has to be some legal changes in the RBI Act for that. That is already commenced. When that happens, this will be a seminal change for the corporate bond market, because the bonds will become more useful. They can be given as collateral and banks can borrow money against it. That will be a very big boost. But nevertheless, you will have to say that the Reserve Bank has taken a goodish number of steps to encourage the fixed income market. It is Rajan's last gift to the corporate bond market and to the fixed income market. It's a big start, and one hopes that more steps will be taken.
All right, Lata, thanks so much for that. Time now for a quick break, but coming up next on the earnings radar tomorrow, the country's largest automaker, Tata Motors, will reveal its first quarter earnings. We'll tell you what to expect. Welcome back. You're with Markets Forward. Now, Biocon is going to be in focus tomorrow on the back of a positive development. The European Medicine Agency has agreed to review Biocon and its partner Mylan's application for a biosimilar version of a very important cancer drug. In fact, the market value of this drug, which is called Trastuzumab, is about $6 billion. Ekta is joining in with the details. Ekta, I don't know if I got the pronunciation right or not, but it's a very important drug, so give us the details.
Well, yes, it is an important development which has come in for Biocon post-markets, where Mylan and Biocon, remember that they have a partnership for a range of biosimilars as well as insulin products which are under development by both of them, where they have announced that the European Medicine Agency, which is basically the regulatory authority there, has accepted for review Mylan's application for one of the proposed biosimilars which is being studied for cancer, Trastuzumab. We understand that it's around a market size of $6 billion in terms of breast cancer as well as gastric cancer, which is being studied for, and hence it is now going to be reviewed by the European Medicine Agency. Remember that this is the second product in this biosimilar range which Mylan and Biocon have in terms of partnership, which has gone in for an approval by the EMA. So it is a big positive. It indicates that Biocon is moving rapidly in terms of its R&D portfolio, and hence we should possibly see some upside on the stock on account of this news.
All right, Ekta, many thanks for that. Now on the earnings radar, it's all about Tata Motors. Naveen Shetty is here to tell us what to expect.
Well, Street is expecting a steady quarter for Tata Motors. The revenue is expected to grow anywhere around 5.6%. This growth is majorly aided by a healthy revenue growth in JLR. JLR revenue is expected to grow by 5%. As we know, JLR contributes to almost 80% of the total revenues of Tata Motors on a consolidated level. Now, the margins are expected to soften a bit by almost 90 basis points at around 14%. The key things that the Street will be watching out for is the JLR volume growth, which has come in at around 17%. That is one thing which will be aiding the overall growth. Also, domestic volume growth is expected to be growth is around decent 7%. So these are the key factors which will be Street will be watching out for. Also, a decline in passenger volume is majorly due to the launch of new Tiago. Also, the response to the new Jaguar phase as well as FE is contributed to the overall growth. So volume growth is the volume play is what Tata Motors numbers will be reflecting. So expect a steady quarter for Tata Motors. Back to you.
Okay, Naveen, thanks so much for that. Mayuresh, I want to get your thoughts in on Tata Motors for sure. I mean, whether the dream run can continue, that stock's not too far away from its 52-week high. And in case you track Biocon, your thoughts on the development from Europe?
So first on Tata Motors will be again on a year-on-year basis. I think the performance should be quite reasonable for Tata Motors, both in JLR terms, where our own expectations is a 13% rise in volumes taking place. Realization should be quite stable, and on the JLR front, because of the new launches that we've seen and the good response both on the wholesale and the retail side, the margins should hold up beyond 15% for JLR. On the standalone business, I think you will see some amount of increase on a year-on-year basis on the CV side of the business, but largely I think the quarter-on-quarter performance in terms of both volumes and realizations will be a little bit soft. But on a YOY comparison, I think the stock should have a 5.5% operating income uptick. You should probably see a profit between 2600, 2650 odd crores. And largely again, I think the platforms that Tata Motors is launching, the kind of launches on the PV segment, even in India, I think that should hold up the PV business and the volumes quite steadily. So again, I think maintaining my positive outlook on Tata Motors from a long-term perspective. For Biocon, I think the approval that they've received specifically from the European agency, I think a positive development on that front. The biosimilars portfolio has been doing quite well, and over the past few quarters, Biocon has upfronted or uploaded rather the R&D cost in a significant manner. So in that sense itself, I think all these efforts paying off in terms of key approvals coming through from various regulators. So again, I think the positive moment should be seen in the stock, at least in tomorrow's trade.
Okay, so those are some stocks in focus. Let me add one more to that list. That's going to be J. Kumar Infra Projects, and that's because after all the confusion surrounding whether it will get that coveted Mumbai Metro Line 3 order or not, the company today came out with an announcement to the exchanges saying that it has indeed bagged that order. The value is pretty significant. We're talking about an order which is going to be over 5,000 crore rupees. The stock today itself, of course, closed in upper circuit. There was a 5% circuit going on the stock with, of course, a lot of excitement around this potential order wins. That was today's performance on J. Kumar Infra. But if you take a look at the last 1 year, then of course it's been a major laggard. All right, so on that note, Mayuresh, some final thoughts. I mean, lots of these individual stocks obviously are flying around for either the right reasons, the wrong reasons. There's Wellspun that's been the talk of town this week. There's J. Kumar, which might be in focus tomorrow. What is it that you would advise buying now?
Again, from a sectoral perspective, again, private sector banks, NBFCs specifically catering to the housing finance segment is something that we still believe in a staggered way on corrections can be looked at. Cement stocks have moved significantly, but our own take is that post Q3, I think with the kind of infrastructure and developmental push, and again, I think the real estate push that the government is embarking upon, the utilization levels should improve significantly over the next few quarters. Realization should remain stable and start increasing quarter after quarter, and that will give the operating performance on cement companies' balance sheet, because a lot of capex probably has come through. Largely, I think EPC is a theme that I continue liking. PNC Infratech is one stock that I'll probably like to highlight. Any correction onto these stocks can be taken as a buying opportunity. I think a large order book of around 5,500 odd crores. They've posted margins for around 17% for FY16, PAT margins of 9%. The kind of debt that they've got on its book is quite reasonable for an EPC player, and that entire debt is on the BOT project portfolio, which is completely operational at this point of time. They're bidding in for the hybrid annuity projects, which is extremely margin accretive for the company going forward. And even on the EPC theme, I think the management expects 4.5 or minimum 5,000 orders to probably flow through in this fiscal with greater margins. So my own own sense is that the operating performance should improve for PNC Infratech. Any decline onto this stock, and within this theme itself, I think EPC should do well over the next 4 to 6 quarters.
Okay, Mayuresh, great having you on the show. Thanks for joining in, of course, sharing some of those interesting ideas as well with our viewers. We'll take a break on that note. On the other side, we'll get some technical ideas from Rajat Bose.